We've had lots of talk, we've had lots of hype, lots of money been raised for these to take these distressed assets, and it's all proved to be rather underwhelming, shall we say. Now, obviously, there's been a large government stimulus package, a lot of bank bailouts, which have encouraged this sort of pretend and extend expression. So, I wonder if, Dennis, you'd like to start us off and just discuss whether you do think this sort of pretend and extend approach has been encouraged, and where we're going to see this moving forward.
I think the concept of extend and pretend, it's a very interesting soundbite. You know, it's very snappy, it's very punchy, and it has an element of truth in it, so it makes it very, very interesting soundbite. But we need to be very clear that when we talk about distressed assets or distressed loans, it covers a very, very broad spectrum. So do I agree that there has been an element of extend and pretend in the banking market? Absolutely. In the CMBS market, we've seen it too. But do I think it's as widespread as some people would perceive? Probably not.
Do you think really that it has been a lot of hype, or do you actually think there has been some sort of action, if you like, going on?
I think we have to distinguish about the lenders, the type of lenders which had loans on their books. For the commercial bank or the universal bank, indeed you have a difference between banks which had government help and the one who had not. The one who had government assistance, mostly they got time to work out the portfolio, and there was an active decision by both the bank and the respective government to say, well, we have a choice. Either you transfer your loan to a bad bank or you sell your portfolio immediately. Now, from a bank perspective, and what banks have done for 2 years, they had the time to create workout teams, work out this loan, and by chance or by good view, indeed, the value of the estate went up, and some of this distressed portfolio is not distressed. However, part is still distressed, and there's a lot of capital allocated to that, and Basel III, which determines the capital to be allocated to real estate loan, will not help. And this bank, at one point in time, will have to dispose of these assets because it's too expensive for them to hold these assets. So there's an opportunity.
So Raymond, over the last couple of years, have you been able to profit from this market, trade on this distress? Has it been an underwhelming market for you or an overwhelming market?
Well, it has really been an underwhelming, as you mentioned at the start, for us. In terms of the debt opportunities, we work in the value-added opportunistic space of the market. So when the decline came and we saw markets coming down, we looked, where is the opportunity coming from? Is it coming from equity investments or is it coming from debt investments? At that point in time, we believed strongly it would come from debt investments, being able to pick up the distressed loans from the banks, work them, or either foreclose on the loans and take in the assets. Either way would have worked for us. There certainly will be some opportunities, and there are some debt funds in the market currently that are looking for opportunities. Certainly on the core side, where the prime type assets were in the early stage, and we're going back, say, to the middle of 2009. There were still opportunities to provide mezzanine loans for recapitalization of these type of prime assets. That has gone because the market has built out these prime assets, and there is really very little distress to be found in those. There's plenty of equity capital, specifically from sovereign funds, that is looking for those type of assets, and prices are, in some cases, even higher than they were before the crisis level.
So, Dennis, any money left?
From some banks, yes, is the answer. Bank lending, is it the elephant in the room? I think you can probably extend that beyond bank lending and real estate into both real estate and corporates. I think you can extend it also from just bank lending and into the debt capital markets. So include CMBS, include some of the bond structures, include private placement as well. And in the context of that, there are some banks who are better placed than others, for sure. There is a colossal overhang, though, and what we see is a big refinancing spike in the corporate market that comes at us across Europe in 2012, mid-2012. And then if you overlay real estate refinancings that are due, that spikes further, we think, during 2013. So in answer to your question, it is a very big issue that hangs out there, not confined just to bank lending, but the whole financing agenda.
So just finally, Mahdi, looking forward, distressing or not?
Well, then you may want to ask the question: what's more distressing, to buy today in today's market a prime property at 475 and put 50% debt on that, or to buy a long income stream in a secondary market, say at an 8, and probably with very low debt on that. So I think the market will find its market clearing. I think what is more important from a global point of view is to see if we may have a double dip in the real estate markets without even having a double dip in the economy. We're probably out of a double dip in the economy, but with the amounts, the sheer volumes of refinancing that we're talking about in the next say 5 years, if the markets today are moving away from those so-called secondary markets, we may have a self-fulfilling prophecy. So we're very concerned with the implications on the direct real estate markets, and that actually creates opportunities in the debt spectrum, but also in the direct markets. And I think this is where any investor and strategist should be looking at. What are the opportunities that will be created if no one is actually looking into secondary markets in the office sector in Southeast England, or shopping centers, medium-sized shopping centers in sort of tier 2 locations in the UK, or CEE office markets or logistics or retail. You could actually have very good opportunities either with a bank or in the direct market. And I think this is where we're actively looking in different strategies.
Great.